Today, I want to talk about how the shorts are about to tap out and accept the squeeze. I want to explain how they're trapped with dwindling cash reserves, why they'll soon be margin called in this dog-eat-dog world, and also explain how they're terrified of a split with yet another lawsuit. So stay tuned and let's make some money. Now I'll dive straight in with the key information. So, Top G tweeted saying he took some of his time to explain what will happen to the AMC price with the split and without the split, but I want to explain why I think that this isn't actually true. So he tweeted saying, let me make it very clear, the high cost to borrow for a stock is not at all bullish. 1000% borrow fees for AMC doesn't actually make it bullish for AMC. He said the reason is because the shorts are happy to pay 1000% borrow fees because they still think they're going to be profitable on their AMC short position. He said anyone that's saying that hedge funds are trapped is wrong. But as I said, I want to explain why I don't think that's quite correct. Now, Top G explained he thinks the shorts are happy to pay 1000% borrowing fee because they're still going to be profitable on their short position regardless of those borrowing costs. Okay, basically saying they're shorting profits minus that borrowing fee will still leave them profitable and with cash at the end. But as I said, let me explain why this isn't actually correct and why the shorts are indeed actually trapped. So the maximum profit these shorts can generate on their AMC short position is if AMC falls from $5 per share all the way to $0 per share and goes bankrupt. Now, if AMC falls from $5 per share to $0 per share, that's a 100% gain or $5 per share as a gain. If they short 1 million shares at $5 per share and it goes all the way to zero, that's a $5 million profit. Now, the AMC cost to borrow is 1000%. And if you didn't know, 1000% in borrowing fees is larger than a potential profit of 100%. The number 1000% is a bigger number than 100%. To put that in terms of dollars, these shorts are paying $50 per year when they know their maximum profit they can generate on their short position is a further $5. And if they borrow 1 million shares at $50 per share per year, that's a $50 million loss on borrowing fees alone. And obviously $50 million of borrowing fees against $5 million of profit if AMC goes all the way to zero is still a $45 million loss. The only way these shorts can be profitable on their short positions is if AMC goes to zero and they generate that 100% profit before they pay 100% in borrowing fees. For example, if AMC goes bankrupt in 10 days, these shorts only spent 20% on their borrowing fee. They generate that 100% profit on their short as AMC goes bankrupt, take off that 20% borrowing fee, and still made an 80% profit. But if they continue shorting AMC and AMC doesn't go bankrupt for a full year, they've made less than 100% profit on their short and still paid 1000% interest on their borrowing fees. Basically saying AMC has to go bankrupt in just 25 days or they've effectively lost money because they've paid more than 100% in borrowing fees and obviously haven't made 100% on their short position. So in fact, these short sellers paying these 1000% borrowing fees either means they expect AMC to go bankrupt in less than 25 days, or more likely, they're stuck in their short position and cannot escape. Also, you can currently get a guaranteed free share of Tesla and a cash reward, which you could always use to buy more shares of AMC, GameStop, or a vape. All you have to do is sign up to Moomoo using the link in the description below and make the required qualifying deposit. Signing up to Moomoo is free, it just requires a temporary deposit, and it's a really great way to support me and to support the channel. And on top of that, Moomoo is very easy to use. They've got tons of technical indicators and even their own options trading platform. But interestingly, Wasteland Capital tweeted saying people seem to ignore or people seem to forget that interest rates are a zero-sum game. He said one person's interest expense, like the shorts paying that borrowing fee, very literally, is another person's interest income. Obviously, if these shorts are locating and borrowing shares, even if they're not locating and borrowing all the shares, they're still borrowing shares from somewhere and paying that borrowing fee to someone. I wonder if it was potentially BlackRock and Vanguard's plan all along to keep these shorts trapped in their short position, paying these sky-high borrowing fees. Because obviously we know it's not AMC retail investors that are lending out those shares, it's likely Vanguard and BlackRock. And at the moment, BlackRock and Vanguard are making money hand over fist by lending out those AMC shares, clearly for massive profits. And I wonder if that was their plan, to sucker in these shorts thinking AMC would go bankrupt, just to trap them in their illegal short position, charging them sky-high borrowing fees. Now, John also tweeted saying, one thing the stock market has taught me in the last 2 years holding AMC is that hedge funds and market makers can do whatever they want with zero repercussions, with no investigations, with no margin calls, with no regulation, and no SEC rules being followed. Now again, while I do think the shorts have had zero investigations and regulation enforcement, what I don't believe is that shorts can escape margin calls. So again, let me explain why. So we know that Citadel borrows the majority of their margin from Bank of America. Citadel has a fund of $350 billion, has cash of their own of $50 billion, using this 7-to-1 leverage ratio. So that means Citadel has $50 billion in cash, and Bank of America is giving them an additional $300 billion. Now, what happens if Citadel loses $60 billion cumulatively on their trades through 2022 and through shorting other stocks like tech stocks and growth stocks so far in 2023? Well, obviously the first $50 billion is absorbed by Citadel, leaving them with $0, losing that entire $50 billion in cash. The remaining $10 billion loss, it's actually Bank of America that loses $10 billion. Now, Bank of America may be able to take that loss on the chin. We know they've already lost $100 billion last year on bonds, and we know that Credit Suisse lost $5 or $10 billion from Archegos, and a bunch of other banks also lost billions and billions of dollars from Archegos too. These banks clearly aren't too worried about losing a few billion here or there, and therefore often allow these hedge funds and market makers to exceed their margin requirements without margin calling them. But let's say Citadel actually lost $150 billion. Obviously, Citadel only has $50 billion in cash, so the first $50 billion is absorbed by Citadel. But that means the additional $100 billion loss is suffered by Bank of America. Now, while Bank of America may be able to tolerate a couple billion here or there, maybe even 10 or 20 billion for a brilliant client like Citadel, I don't think they'd be happy with a $100 billion loss in this dog-eat-dog world. Don't forget, these banks and hedge funds are competing against each other. They may help each other out every now and then with a couple $1 billion in loans here and there, but all of a sudden, one bank or hedge fund isn't going to be happy losing tens or hundreds of billions of dollars if it's not their own fault, but a different hedge fund's fault. Bank of America may give Citadel some leeway and say, guys, it's okay that you've lost $5 or $10 billion, we've got you. But all of a sudden, when that $5 or $10 billion loss turns into $100 billion in losses, or even more, all of a sudden Bank of America somewhere will pull the plug. I don't know how far they need to exceed those margin requirements, whether it's by 2%, 10%, 25%, 50%, or even more, but at some point Bank of America will indeed pull the plug. So it's clear to see the shorts are indeed trapped, as they're paying 1000% borrowing costs against a maximum potential profit of 100%, unless they expect AMC to go bankrupt in just 25 days. And at some point, their luck will indeed run out and they will be margin called by Bank of America. And we can also see these shorts are indeed petrified of the AMC reverse split, as a third lawsuit has just been opened up against AMC. This is an emergency application to review and throw out the settlement brought by David D. Madris. But as Jan tweeted, he said, nice try. It will be dismissed because Delaware corporate law now states that companies incorporated in Delaware can authorise corporate action by passing a stockholder vote. As Stephanie added, she said, this smells of desperation. If you think the reverse split is good for the shorts, this should show you that it kills them. She said they are fighting so hard to delay or cancel the reverse split, starting lawsuit after lawsuit after lawsuit. Biggums added, saying they are scared to death of this conversion because it kills their short thesis, so they're going to do anything they possibly can to stall that conversion and reverse split. He said if people can't figure out that the reverse split screws the shorts, I don't know what to tell them. I think this combines so perfectly with the fact the shorts have lost control of cost to borrow, they've lost control of fail to delivers, and all they're trying to do to escape their positions now is to start lawsuit after lawsuit. Now, I also saw this really interesting tweet from Susan Trimbath that she thinks is talking about share intel. Now, this is taken from an interview of a senior employee at Overstock, and he said Overstock asked me to work with a service provider, likely ShareIntel, to help them look more deeply at the available records available from their transfer agent and from the DTC. He said, when I met with the head of the service provider, at the insistence of Overstock's lawyers, the company's CEO of ShareIntel offered me compensation to recommend his services. But his personal review and due diligence found nothing to convince him that there was value in ShareIntel's service. After looking at the product they were providing, I warned Overstock and a few other companies that the service had no value, because the information is freely available elsewhere. Overstock insisted that they wanted me to review all their reports and provide Overstock with an opinion of the value in the ShareIntel work. But he said my meeting with the CEO and a few subsequent phone calls with his staff only confirmed what I already knew. Not only was there no value in this service, but it was also giving him incorrect information about his shareholders and the potential phantom shares in circulation. And Susan added, saying NSG Readers, which is the magazine or publication that this interview is published in, saying they may have already figured out who this company is. And she said, I know that Adam Aaron did. Basically saying that Susan Trimbath believes Adam Aaron knows that ShareIntel is pretty much useless, and that's why Adam Aaron never engaged ShareIntel. Especially when you think about all of the other companies that have engaged ShareIntel, like Mullen, Fingermotion, and a bunch of other companies that have definitely not seen a squeeze since engaging with ShareIntel. It's likely that ShareIntel just drains money from these companies even further, and it's maybe even possible that ShareIntel is actually working with the shorts. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.